Imagine waking up one morning and your money is worth 20% less than it was yesterday. Nobody broke in, nobody stole anything. The cash in your account did not move. And yet a huge chunk of your wealth just quietly vanished into thin air. This is a stock market crash, and every few years the headline starts screaming that another one is coming. So what actually happens when the market crashes? Where does all that money really go? And why does it keep happening over and over throughout history? Today we break down exactly why the stock market crashes, drawn simply. And stick around, because the last part is the one that decides whether a crash makes you poorer or quietly makes you rich. To understand why the market crashes, you first need to know what the market actually is. Forget the scary red screens for a second. A share of stock is just a tiny slice of ownership in a real company. Buy a share, and you own a microscopic piece of that business, its buildings, its brand, its future profits. The stock market is simply a giant place where millions of people buy and sell these tiny slices all day long. And here is the key idea. The price of a stock is not a fixed fact. It is just whatever the last person was willing to pay for it. That means the price is really a measure of one thing: how people feel about the future. When people feel confident, they pay more and prices rise. When people get scared, they pay less and prices fall. The whole market is a giant mood ring for the economy. So what exactly is a crash? Prices go up and down a little every single day. That is normal. That is just noise. But sometimes prices fall a lot, very fast, across almost everything at once. When the market falls 10% from its recent high, that has a name. It is called a correction. When it falls 20% or more, it gets a scarier name: a bear market. And a true crash is when a big drop like that happens shockingly fast, sometimes in just days. The value does not leak out slowly, it falls off a cliff. So the real question is, what makes millions of calm people suddenly panic and sell all at once? The answer is a feedback loop, and it is powered by fear. Here is how it works. It starts with a trigger. Some bad news. Maybe interest rates jump. Maybe a big company disappoints. Maybe a war or a scare. That trigger makes a few people nervous, and they sell. Their selling pushes prices down a little. Now other people see the price falling, and they get scared too, so they sell. That pushes prices down even more, which scares even more people, who also sell. Falling prices cause fear, and fear causes more selling, which causes more falling. The loop feeds itself, faster and faster, spinning down into a crash. Nobody is coordinating it. It is just millions of scared people all running for the same exit at the same time. But fear alone is not the whole story. Two things pour gasoline on that fire. The first is bubbles. Sometimes, before a crash, prices float way up, far above what the companies are actually worth. People stop buying because a business is good, and start buying just because the price keeps going up. That is a bubble. And every bubble is a balloon looking for a pin. When reality finally shows up, the balloon does not deflate gently. It pops. The second accelerant is the scariest one. It is called leverage. Many investors do not just buy with their own money. They borrow money to buy even more stock, hoping to multiply their gains. This works beautifully while prices rise. But when prices fall, it becomes a trap. The people who lent them the money get nervous and demand it back, right now. To pay it back, these investors are forced to sell their stocks immediately, at any price, whether they want to or not. This is called a margin call, and it creates a wave of forced, panicked selling that has nothing to do with choice. Fear makes people want to sell. Leverage makes them have to sell. Together, they can turn a normal dip into a full-blown crash. Now, here is the question that haunts everyone. Where does the money actually go? If a company loses $1 trillion in value in a day, who got that $1 trillion? And the strange, almost magical answer is, mostly, nobody. The money was never really sitting there in the first place. Remember, a stock price is just what the last person was willing to pay. Say a company has 1 million shares, and the last share traded for $100. On paper, everyone agrees. The whole company is worth $100 million. But if fear hits, and the next share only sells for $50, then on paper, the whole company is now worth $50 million. $50 million of value just disappeared, but no actual pile of cash moved anywhere. It was paper wealth, value that existed only because everyone agreed it did. A crash is the moment everyone suddenly stops agreeing. The money did not go somewhere. It simply stopped existing, the same way it appeared on the way up. So if crashes are this scary, here is the twist almost nobody wants to hear. Crashes are completely normal. They are not a glitch in the system. They are a built-in feature of it. Look back through history and you see the same pattern again and again. The market climbs for years, gets too confident, crashes, everyone panics, and then, eventually, it recovers and climbs to brand new highs. It happened in 1929, in 2000, in 2008, in 2020, and it will happen again. Every single crash in the history of the American market so far has eventually been followed by a full recovery and new record highs. I have to be honest and careful here. Past recoveries are not a promise that it always will. Nobody can guarantee the future. But historically, the pattern has been remarkably stubborn. The market falls, and then it gets back up, which brings us to the part that actually matters for you. For a long-term investor, a crash is not the disaster it feels like. It is a sale. The exact same slices of the exact same great companies suddenly go on sale for 30, 40, 50% off. This is why you will hear that the rich get richer during crashes. While scared people are panic selling at the bottom, calm people with cash are quietly buying those discounted shares. Then they simply wait for the recovery that has always, so far, come. The real danger of a crash was never the crash itself. The danger is letting fear trick you into selling at the very bottom and locking in a loss that was only ever on paper. The people who get hurt most are not the ones who lived through the crash. They are the ones who ran away during it. So the next time the headlines scream that the market is crashing, remember what is really happening. It is not money being stolen. It is fear spreading through a giant mood ring, popping a balloon that floated too high. Paper wealth is vanishing the same way it appeared, and somewhere, calm people are treating the whole thing as a sale. A crash only turns into a real, permanent loss the moment you panic and sell. This is not me telling you what to do with your money. I am not your financial advisor. It is just the machine, explained. So the next time everyone else is panicking, you actually understand what you were looking at. If this helped the fear make a little more sense, subscribe, because that is what I do here, break down the money behind everyday life, drawn simply. I will see you in the next one.